So today we're going to talk about the history of bear markets. Generally speaking, the definition of a bear market is a peak to trough decline of 20% or more. And so under that definition, the last bear market was from 2007 to 2009 when stocks fell significantly. We haven't had a bear market recently. We've had a couple of corrections, just barely dipping into correction territory here in 2018, down about 10%. The good news is that bear markets are relatively infrequent. Stocks go up a lot more than they go down. The longer the time frame of an investment, the more likely the market is to go higher. 53% of days, stocks go up. But 72% of years see the market go higher as opposed to lower. And it's actually pushing 90% of the time over the course of a decade, stocks are up, not down. That being said, you do see market declines. On average, once every 12 months, the stock market declines from peak to trough by about 14%. And the average length of that peak to trough decline is about 56 days. Think about it like this. What happens once per year, lasts a couple months, and is relatively unpleasant? And yeah, market corrections are a little bit like winter. If you live in the Northeast and it's November, you know that at some point it's going to snow. Now, you don't know if it's going to snow in December, January, March, or maybe it won't snow until the next year. And when it does snow, you don't know if it's going to be 2 inches or 2 feet. But the key point is you know that at some point this unpleasant thing is coming down the road. So you prepare for it. Maybe you stock up on wine and cheese, you get a Netflix subscription, and it snows, and you know what? You're happy. Bear markets are the same way, right? People that are prepared, whose portfolios are properly allocated, who are ready for it, well, it's still frightening because of the unknown, because you don't know the timing of when it's going to happen, you don't know the severity or the cause. But having preparations in place certainly make it easier to withstand the bear. The other thing about it is that not every one of those corrections becomes a bear market. In fact, most of the time when the market goes down, it bounces up pretty quickly. Think recently, a couple examples. The Trump election. The word going into the election was if Trump won, markets were going to fall. And markets cooperated. They fell. They fell for about 15 minutes, or maybe 4 or 5 hours, but the Dow plummeted, recovered before trading even opened up that day. Or what about Brexit back in 2016? Markets fell sharply for about 6 weeks, and then recovered and went straight onwards and upwards. So not every correction turns into a bear market. But what about those that do? Since World War II, there have been 11 bear markets in the United States. Those bear markets have lasted anywhere from 3 months to 36 months. The declines in those bear markets have been anywhere from 20% down to 57% down. The average decline is about 30%. And what about what you really care about, which is the recovery? Well, on average, it took about 6 years. When a bear market is actually occurring, you're not going to care what all the statistics tell you. Bears are scary. I mean, look at this bear on screen right now. I have young kids and I have a golden retriever. I'm thinking of trading in the golden retriever for this bear. My kids can hang out with it, watch TV, use it as a blanket, snuggle up with it, because it's a pretty peaceful looking bear. But what's the other thing you notice about this bear? Yeah, those 6-inch claws. And I think this is the perfect representative animal for financial markets because most of the time, markets are calm. The bear is at rest. 2017 had some of the lowest volatility in historical record. But then every once in a while, the bear takes out the claws and rips somebody to pieces. And that's what a bear market is like. If bear markets, you knew exactly when it was going to happen and what it was going to look like, it wouldn't be so terrible. I could sit on this video and virtually guarantee you that at some point in your investment lifetimes, there will be another bear market. But what I can't guarantee you or tell you with any sort of certainty is when it will occur. I can't tell you what will cause it, and I can't tell you how severe it will be or how long it will last. What I can do, though, is tell you it's going to be frightening, it's going to seem completely unexpected, and this time will be different because this time everyone knows markets aren't going to recover and everything is going to zero. But of course, that's not the case, right? How do you know when a decline is going to turn into a bear market? I don't know. That's an open question. Maybe you have the answer. If you do, call Pure Financial. We'd love to hear from you. We're hiring. Nobody knows exactly when a bear market is going to occur or what it's going to look like. That gets back to the whole uncertainty aspect. There are, however, some factors that can lead to, once a bear market occurs, it being more severe. And in general, if you look at the historical record, if the economy weakens significantly, so if you have a sharp decline in gross domestic product, and if you start at high valuation, so if stocks are very expensive at the beginning, those two factors taken in conjunction lead to more severe bear markets. You won't necessarily know if stocks are overvalued or if the economy is falling that you're going to have a bear market. But given that set of circumstances, if you do have a bear market, it's more likely to be of the 30 or 40% decline type as opposed to the 20 or 25% type. So now we know. If there's a recession, there's a higher likelihood that stocks fall. Great, right? All we need to do is look at the economy and we'll know what's going to happen with the stock market. If only it were so easy. My life would be simple. Your investing life would be simple. But unfortunately, we run into a chicken and an egg problem. Stocks are a leading economic indicator. What I mean by that is stock recoveries generally presage economic recoveries, and stock declines can sometimes indicate that the economy is going to fall. Economic declines, as measured by falls in GDP growth, are coincidental indicators. In other words, it occurs in real time. If stocks are causing the economy to fall, and yet we're going to look to the economy to tell us whether or not stocks are going to fall, we get into circular logic, and around we go. The pun goes that stock market declines have predicted 12 of the last 7 recessions. Just because stocks are falling doesn't mean you're going to have a recession. In nearly half of the recessions since World War II, stocks have actually increased because they're a leading indicator. So in other words, usually by the time the economy enters into a recession, stocks have already suffered a lot of their damage. They've fallen. Maybe they continue to fall, but they're usually into recovery well before the economic cycle turns, which is why it's so difficult to time markets at bottoms, because usually stocks are bottoming right when the economic cycle is worst and right when the news is worst. But what about another topic du jour as far as trying to tell if the economy is going to fall, and if so, what does that mean for stocks? Lately, we've been hearing more and more about what's called the inverted yield curve. And so a yield curve is simply taking the maturities of the various treasury bonds, taking their yields and plotting them out in a graph. The shape of that is often upward sloping and resembles something like an upside down fishhook. However, on rare occasions, it becomes inverted. The longer you lend your money for, the less return you get. Historically, that's been an indicator of a slowing economy and of an economy that may fall into recession. Importantly, right now, the yield curve is not inverted. It's reasonably flat, so the difference between short-term returns and long-term returns in the bond market is not that great, but it's not inverted. A flat yield curve statistically has no correlation to economic activity. It's only when it truly does invert that it has any sort of economic correlation. Even when the yield curve does invert, if you do go into a recession, there's a gap between when the economy goes into recession versus when the yield curve inverted, on average of 1.5 years. Tough to time markets given that time lag, particularly because in the interim, the average additional increase of the stock market has been 15%. So in other words, you see the yield curve invert, you say, wow, there's going to be a recession coming, let me get out of the market. And in the meantime, it's 1.5 years later and the market's gone up 15% before perhaps the economy slows down. Not necessarily a recipe for investment success. So we've talked a lot about bear markets, the difficulty of timing them, what to do. Well, a couple things. First of all, if you could successfully predict a catastrophic bear market, and here I'm thinking of something akin to what followed the 1929 stock market crash into the 1930s in the US and the Great Depression, which saw declines of up to 86% in stocks, get out. Bear markets like that are very unusual, though, and difficult to predict. What do you remember best about bear markets? You remember the tech crash of the early 2000s and the financial crisis of 08, 09. Those are probably fresh in your mind. Out of all the bear markets we've had since World War II, those were 2 of the 3 worst, equaled only by the mid-1970s. So very, very severe bear markets we've seen lately. At some point, yes, we'll have a bear market. Will it be that severe? I don't have the answer to that, but if you look at the statistics and history, it would say likely not. But still, what do you do when a bear is coming? I don't know about you, I run, right? A gigantic bear is chasing me, I'm out of here. The problem is, when a bear market happens, human instinct is to panic and run, sell everything and get out. But in fact, a bear market may happen, it will happen, but doing nothing is generally the best course of action. So that's what you should do reactively. But what about proactive steps you can take to protect yourself? Remember, I talked about winter was coming. That sounded too much like Game of Thrones, but you get the gist of it for you Game of Thrones watchers. Winter will come at some point. What steps proactively should you take to prepare your portfolio for that next bear market? Well, a couple things. First of all, make sure your portfolio mix meets your long-term goals and your risk tolerance. In other words, if you're retiring in 5 years, you should not be 80 or 90% in stocks in all likelihood. Or at the very least, you should evaluate whether or not that's appropriate. Maybe you started off 60 or 70% in stocks or 50% and your portfolio drifted due to the long upward run in stocks that we've had. That's where rebalancing comes into effect. Set your strategic allocation based upon your financial planning, based upon your goals and risk tolerance, and then rebalance consistently to maintain that allocation. Stay the course. Staying the course, again, it's one of the hardest things to do, but you set your financial plan and your agenda in place for a reason. You shouldn't deviate just when external circumstances are the worst. Finally, hold some bonds or other safe assets in your portfolio. And again, everybody's going to be different, so this advice doesn't necessarily apply to everybody. Some people should be 100% in stocks, but for those of you that's not appropriate, bonds aren't exciting. Nobody gets excited about earning 3 or 4%. But they're there for a reason. They're there to generate some income and to provide some stability to a portfolio. Having those safe assets cushions your portfolio in a downward market and also provides dry powder to potentially rebalance into stocks when they're on sale. Remember, dollar cost averaging is a timeless investment principle, but that doesn't only apply to new money. The act of rebalancing a portfolio is effectively dollar cost averaging into a portfolio as stocks fall. Remember that compound interest is your friend. Over time, stock markets go higher. The Dow was at roughly 1,000 back in the early 1980s. Today, it's around 25,000. Let that upward power, that upward momentum, compound interest work in your favor by staying the course and remembering that although in any given day, week, month, year, stocks can be very volatile and can sometimes fall, over the course of time, they historically have tended to go higher. I was listening to the podcast recently with Joe and Big Al, and they had Jonathan Clements on. And Jonathan said,
unless you think that the economy will never grow again, that we are going to be stuck here forever, we're never going to see further improvements in our standard of living, we're never going to see companies grow again, why would you get out of the stock market? I mean, the stock market in the end is a reflection of global economic growth. As long as the economy grows, the stock market will rise.
Now that's advice I can agree to. The Gettysburg Address is one of the greatest speeches ever written. It was only 272 words, which proves that when it comes to public speaking and getting points across, brevity has power. Let me now turn to the words of the famous mutual fund manager Peter Lynch, who said in 24 words what I've just spent 10 minutes saying. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. I can't think of a better note to end on, but if you do want more information on this or any other financial topic, contact us at Pure Financial. Coincident indicator. In other words, I can't say that word.
Yes, you can.
As of this recording, in May of 2018, it's at roughly 25,000. All right. Why can I not remember what to say? This is like the blooper reel.